Hey everybody, Joshua Phillips here at Churchill Mortgage. It is November the 1st. Can you believe there's only about 9 weeks left in the year? That is truly crazy, but that's not what we're here to talk about. I'm here to talk about mortgage rates and what is happening in the economy. So as you can see here, I always like to start with a CNBC headline or article. Well, we got a jobs report today and it was pretty bad. Only showed 12,000 new jobs, which is extremely low, even considering the catastrophes we've had the last couple of months and the strikes. It's still pretty bad. So, and but right here it says, Dow Jones closes 300 points higher, despite the basically saying they're shaking off the weak jobs report. So, I don't know what exactly is going to slow down this economy, but even a slow jobs report doesn't seem to really matter right now. So, it started out as a good day. It looked like a good day for mortgage-backed securities. And by the way, so we're going to flip over here to mortgage-backed securities, which is what we usually show when we're talking about mortgage rates. As I always like to say, every professional loan officer in America has this chart up on their screen all day as we're just kind of keeping track of what's happening in the markets. Mortgage rates derive their values from mortgage-backed securities. All you need to know to read this chart is that red is bad, green is good, and the higher the security price goes, the better mortgage rates are doing. It's just the easiest way for me to talk about what's happening with mortgage rates. As you can see, if you've been reviewing these over time, we saw security prices getting better and better and better up until when the Fed cut the Fed fund rate in September. We peaked. Mortgage rates were getting quite good. We were just right there on the precipice of just maybe getting back into the fives. And then wonk, wonk, wonk. Things have gotten worse since then. It's been pretty much all red, and security prices getting worse, mortgage rates going higher. We've seen rates jump, depending on the product and the situation, probably in the neighborhood of 0.75%, unfortunately. Now, we're still better than we were a year ago, but we are off substantially from where we were. Now, for anybody that cares to keep track of these type of charts, what we're hoping for and what we're looking for is a bottom. If you see right here recently, we've kind of touched on this bottom around this 99.8, 99.9 level. We hope at some point we're going to find a bottom, and then hopefully security prices will bounce back up. That's what we're hoping for on the technical side, is some sort of bottom that we can recover from. And I'm hoping that we've achieved that. Now, of course, next week, it's a huge week. Not only do we have the election, we find out, hopefully we find out who won the election. But then additionally, the Fed meets next week. The Fed is expected to cut the Fed fund rate 0.25%. There's like a 95% chance that's going to happen. So very likely the Fed's going to cut the Fed fund rate by 1/4. But, honestly, that was disappointing to the market because the market was expecting and hoping for a 50 basis points. So while it is good, it's not as good as the market was baking in several weeks ago. So we're actually seeing that's one of the reasons why we're seeing mortgage-backed security prices getting worse, mortgage rates going up. So, we don't obviously, no one knows. It's tight rates. No one knows who's going to be elected, and we really don't know what's going to be better for interest rates. I will say this. I'll give just a brief thought on this. The markets do seem to be pricing in a Trump win, with the thinking being by the markets, not necessarily me, but just this is what the markets think, that Trump will be better for the economy, for a stronger economy and his policies overall. And therefore, that is reason why the Fed won't necessarily need to cut the interest rates. So interest rates may stay higher for longer. We may be looking at weeks, if not months, before we get back to the level where we were. And of course, there's no guarantee. But I would say we're at least probably 90 days maybe away from clawing our way back to where we were in September. So it's going to be a while, I think, before we get back to that level. But anyway, in the meantime, we still have people out there buying houses. We still have some people refinancing. We also have been doing a lot of second mortgages and equity lines of credit to help people extract some of the equity from their home. So if that's you, we're certainly here to help. You can always have a personal conversation with me. We can talk about your specific situation, your strategy. Not everybody can just wait and wait and wait for rates to get better. And there are other reasons to purchase a home or refinance besides the interest rate. Well, hope you have a great weekend as we enter into November. Hopefully it's some beautiful weather where you are. And we'll check back soon and see where we are after the election, after the Fed cut. Next week's report could be pretty epic. So we'll see when that comes around. Take care. Bye-bye.